We've covered a number of US investment products, but do you know the risk of investing your millions in US Citus property? In God we trust. God bless America. So many people want to rush into America, settle down there, and cash in on the opportunity. Yes, it is known as the land of opportunity. I don't know about that in 2025 and beyond, but as we know, we had the American dream. But so far, it has had some good days. I don't know about the future. Though foreigners love to invest in these amazing investment products that give good returns, they should remember that as a foreigner, you stand to lose more when it comes to paying taxes, especially if you have invested heavily in America. If you follow the socials and blogs, you'll notice that some people want out because the situation right now is not as it was back in the days. But no matter the situation now, America has done great in the past. And that's the major reason foreign investors flock in to just get a piece of the pie. Lest you forget, the market is cyclic in nature. There are years it will be up, there are years it will be down. It has happened in the past and it will continue repeating itself in the future. Having settled that, the key issue here is that the US citizens and non-citizens are treated very differently when you invest in the US market. So what am I talking about? Because you don't know tomorrow. Before you park your millions in the US economy, keep this in mind. This is what you need to know about the US estate tax system. First, the US estate tax is a tax on the value of assets you own at death when you leave the earth. It's not on income or gains, but on the total wealth you hold inside the United States when it's your time to go. What does estate tax cover? If you own any US real estate, if you own any stocks or ETFs, if you own any bank accounts, especially connected to a US trade or business, okay, or any other US Citus property, that is all captured under estate tax. You see, US citizens are like the favorite child, okay? But now you as a non-citizen, you have to pay to be in the same room with the favorite child. That means that US citizens can die owning millions of dollars in US assets and owe no estate tax at all as long as their estate is below a certain level, okay? Is below that exemption. But what is a tax exemption? It is a removal of a liability to make a compulsory payment that would otherwise be imposed by the government, okay? And note that tax exemption can provide relief from taxes, or it can reduce the tax rates, or it can only be that you are taxed on only a portion of the items you own. For example, the US citizens and US tax residents, even if they're living abroad, they get a huge tax exemption of around $13.61 million, okay? So anything they own above that amount is taxed progressively up to 40%. But if they do not surpass that amount, they are exempt from estate tax. But as a foreign investor, the total exemption you can enjoy is so low, just 60,000 US dollars, and any amount above that, you have to pay 40% estate tax. For instance, if you have assets around $500,000, the US will tax that portion above $60,000 at 40%. So a total of $440,000 will be taxed at 40%. So it sounds more like you're working so hard and investing your money just to pay tax. Oh, so you say you don't have $500,000 invested. Okay, let's take another example. But remember, I've shared episodes where you can get even to $1 million in a number of years, and 10 years is not much. Like from 2020 to today, it's already 5 years are gone. So, okay, let's say you have $300,000 invested, okay? So it will be the $300,000 minus only the $60,000 that is exempt from estate tax. So you are left with $240,000 that is subject to 40% tax. So a whopping $96,000 goes to tax. Okay, that is the 40% of $240,000. What would you do if you had the $96,000, or if you had spent the $96,000? But you may argue some countries are protected. Okay, yes, just a few countries. For example, we have Canada, the UK, Germany, France, Japan, but most countries do not have a tax treaty with the US, okay? So that means many investors, especially in Africa, in Asia, Latin America, they are fully exposed to the $60,000 limit. So how do I avoid this? There are different ways. For instance, one solution would be to invest through non-US domiciled ETFs. For example, the Irish domiciled ETFs that track the S&P 500, okay? We have the CSPX. I'll cover them in the coming episodes. So these ones are domiciled in Ireland, not the US. So they are not considered as US cited assets for estate tax purposes. The second option would be that you can, if you really want to hold large amounts in US assets, then hold the assets via non-US corporations. And finally, the best, if you don't want to pay huge amounts of taxes, is just to maintain under $60,000 for your US domiciled investments. Simple, straightforward. Now you know.